Hi, so we've just finished with base cost. We looked at what can go into base cost, what can't go into base cost, and when base cost is going to be reduced. I left you saying that you can ignore paragraph 20 cap A. Paragraph 21 is just a catch paragraph that says if something allows, or if for some reason two paragraphs allow something to be included, this paragraph says you can only include it once. As we always know with tax, you can't have something deducted or included twice. It can only be deducted or included once. Paragraph 22 is a very cool interaction, and it's an interaction that happens between donations tax and CGT. Now, you may be watching this lecture video before you've done donations tax. There's some nice videos on it. And what it basically says is that when you make a donation of an asset, there's going to be a 20% tax on it, subject to certain exemptions, things like that. What this scenario is to say that when A donates an asset to B, if there's any donations tax that is payable, whoever pays the donations tax may add it to their base cost. So if A is the one giving the asset to B, remember this has to be in a donation for there to be donations tax. We'll see later that any donation is deemed to be made at market value. So the A will be deemed to sell it at market value, so that'll be proceeds, but their base cost will be what they paid for the asset, less all the allowances, all those normal things. But if they paid any donations tax, it gets added to their base cost. However, it doesn't just get straight added, it gets added as per a formula, and that formula is as follows. Y is what you're looking for, it's the answer. A is your market value of the asset on the day you donate it. M is your market value, my apologies. A is the amount of your base cost, excluding any donations tax. That's everything else that you would have in your base cost. So basically, this is going to be proceeds minus base cost, excluding donations tax, over market value. And then you use that ratio, multiply it by D. D is the amount of donations tax, and you apply that to your base cost. What this basically means is if you're making a loss, so if for some reason your base cost excluding donations tax is bigger than your market value, this will be negative, so there'll be no inclusion. Okay, it says so down here. What we need to think about in this, that is if A, the person donating the asset, pays it. Remember from donations tax, we said that the donee or the donor are jointly and severally liable, which means either of them can pay it. If B was the person who ended up paying it, what we have then is B simply adds it in full to their base cost when they will dispose of it later, because remember they just acquired the asset. Okay, cool. There is an example here about how they interact. I don't think you're going to need any guidance here. Okay. If you're confused where this 100,000 is coming from, that is the annual exemption for donations tax. So maybe go and watch the donations tax slides. But otherwise, I think it's a pretty straightforward option. Okay. Cool. Then paragraphs 23, 24, you can ignore. Paragraph 25 is where we start getting into pre-valuation date assets. So it goes, what is this? Who cares? Why should we care? Well, what is this? It's any asset that was purchased before the 1st of October 2001. Who cares? Anybody who owns an asset that was purchased before the 1st of October 2001. Some of you are going, well, why should we care? A lot of you were pretty much just born then. Well, if you're ever doing the tax of anybody that owns any of these assets, you should care. Realistically, we're starting to get to the point in time where the only assets that are going to be pre-valuation date assets are houses or maybe some pre-vintage cars that are not personal use or something like that. But yeah, mostly going to be old houses. The other thing you have to think about, this also counts for any resident who purchased any assets before 2001 and for any non-residents who immigrated before 2001. What happens is that if it was acquired before 2001, as we said before, it's the valuation date value plus anything afterwards. If you acquired it afterwards, it's just your normal allowable expenses and all the other random things. So what we need to now focus on is, well, how do we get this valuation date value? How do we know what the value was on the 1st of October 2001? And that brings us to this monster of a slide. Okay, I'm going to make it big here just to explain. This slide is going to look very overwhelming. And also, this slide has got a lot of information on. This is not a slide that you want to spend an area of your brain learning off by heart. If you do, it's a little bit of a waste, because a lot of these scenarios are never going to come up, or very rarely will come up. What you need to do with this is you need to take this slide, take your act, and then use the information that's in the slide to make sure that how you flag, highlight, do whatever you do in your act makes sense to you. Okay, so you need to be able to take this information and transfer it to your act. You don't need to remember it, but you most certainly need to remember how to use it. Because if you can't use it and the act doesn't make sense and you can't do it quickly, that's a problem. At the same time, you need to know the basic one off by heart, most likely, because that's the one that's going to come up most of the time. Now, also remember, keep in mind the big picture. What we are doing here is working out the valuation date value. This is the value in 2001. You will work out this value and then add onto it, any expenditure that happens afterwards to get your base cost. Now, the ways that we do it depend on certain things. The first one, we're going to look at para 26 and then para 27. How you determine which one you get into is you look at total proceeds, what you sell the asset for, and you look at total expenditure. So that's expenditure before 2001, that's expenditure after 2001. You just look to see if proceeds in total exceeds expenditure in total, regardless of the year, you go to para 26. If proceeds in total are smaller than or equal to expenditure in total, regardless of the years, you're looking at para 27. Now, most of the time, if you have an asset that you bought in 2001, it's very unlikely that your proceeds are going to be less than your expenditure. If you have a house that's dropped in value since 2001, we have a problem. Okay, but you do need to know how this theoretically works. And how it works is we do the following. If you're in para 26, you have 3 options. Okay. Now, valuation date market value. Your valuation date market value is the value of the asset, okay, on the 1st of October 2001. Now, on the 1st of October 2001, obviously government warned everybody, hey, these rules are coming into effect. You should probably value your house. So it would have been a good time for people who are property valuers to do their job. Now, you got a valuation. You could have got this valuation on its own. Government would have published some kind of a valuation table depending on the size and the area, things like that. If that valuation, okay, is smaller, so this is the market value in 2001, if it's smaller than proceeds, which you would expect it to be, you would expect that you're selling it for more than its market value in 2001, you can use any of the following as your value in 2001. You can use your valuation date market value, so this value up here. That value will be given. You don't ever have to work it out. You can use what's known as TAB or TABC. That is your time apportioned base cost. Now, it's again a calculation. It takes into account the number of years before 2001, the number of years after 2001, and apportions the gain between them. You don't have to know how to do it. Okay, lucky you. But you can use that, or you have an option to use 20% of net proceeds. Net proceeds is what you sold the asset for, less any expenditure after 2001. So you take what you sold it for, less any expenditure after 2001, multiply it by 20%, and that gives you your 3 options for your valuation date value. Think about it to yourself. Are you going to pick the highest of those 3 or the lowest of those 3? Take a second to think about it and decide which one it's going to be. Are you going to pick the highest or are you going to pick the lowest? Okay. You are going to want to pick the highest. Why are you going to want to pick the highest? Well, the higher it is, the higher your base cost is going to be. The higher the base cost means you're either going to have a smaller capital gain or a larger capital loss, and that is good. Okay. Then we get to some other scenarios. If your valuation date market value is more than your proceeds, your TABC is simply going to be your proceeds minus expenditure afterwards. That's your only option, no choice. And if you didn't determine your expenditure before, it's going to be any of these 2. You can't do TABC if there was no expenditure before. Okay. If overall your proceeds were less than your expenditure, so you find yourself in para 27, you again have 2 steps to move between. If you didn't determine the value in 2001, that's your TABC calc. If you did determine it, then we look at these 2 things. If your expenditure before was greater than or equal to proceeds and greater than valuation date market value, you pick the higher of these 2. If it's anything else, okay, so if either of these 2, that's not a divide, that's an either, is larger than expenditure before, then you take the lower of these 2. These scenarios, theoretically, you have to know how to treat them, okay? They may come up. I think in real life it's quite unlikely. Know where to look, know how to flag, but usually expect you to find yourself in this area of the graph here, where your overall proceeds are more than expenditure, your valuation date market value is less than your proceeds, which makes sense. You're going to sell it for more than its value in 2001. You can then pick any of these ones. Okay. In a question, I will give you the market value. I will give you the TABC. You will have to work out 20% of net proceeds. If I don't give you TABC, that just means it wasn't calculated. If I don't give you market value, it means it's not there. So you can't make one up. You just work with the other options that you have available to you. If I give you nothing, then you can still always use proceeds minus expenditure afterwards times by 20%. Okay. I suggest you do a couple examples of that, just finding out how to highlight, how to flag, and making sure that it makes sense to you. Awesome. That was hectic, but you can do it just with a bit of time. You can pause this video, which is great as well. But then when we move on, we see paragraphs 28, 29, 30, and 31 speak about how to determine your TABC and TAB, same thing, and how to determine your market value. The good news for you, they will be given to you. Other things you need to know about: base costs of identical assets. So if you have capital assets and you have multiple ones which are identical, okay, you can use FIFO, that's what you have to do, or you can use specific identification, and you can use WACC in certain circumstances. That's just bringing in a bit of costing here if you have base cost of identical assets. If you only dispose of part of an asset, so you have land and you get rid of some of the land, okay, you apportion based on the expenditure on the asset. Okay, so you apportion it based on saying, well, if this land cost me $1 million, I'm selling 60% of it. I take 60% of that expenditure as my base cost. Lastly, para 34 speaks about debt substitution. So if somebody pays you with an asset, you are deemed to acquire that asset at market value, and you're deemed to incur that market value as expenditure for the base cost. So if somebody pays you with an asset, you're deemed to acquire that asset at market value, and that will be the base cost. There's example 6 for you to do. It's pretty simple, comes straight from the textbook, and that just speaks about how debt substitution works. If somebody pays you with an asset. Okay. Where we're going to go next in the next video is to look at proceeds now that we are done with base cost.